In this video, I'll show you why this simple indicator has predicted every US recession for the last 30 years, how it works, and what it's telling us now. But let's first overlay the recessions and I'll show you how it flashes the warning signal. So you'll notice that the red areas represent official recessions, and these always seem to occur when the black line, known as the yield curve, comes from negative to positive. There are actually a few different measures of the yield curve, but let's talk through what it actually means before we look at the current inversion, which is the longest yield curve inversion ever. So this is a plot of the last full trading day yields for different length US government treasuries on a chart that I've plotted in Excel. And what you'll notice is that the yields are higher for the shorter dated treasuries. Now the yield curve, which is what we were looking at on the last slide, is derived by taking short-term yield away from longer-term yield. So that's commonly represented by the 10-year and 2-year treasuries, or sometimes the 10-year and 3-month. Either way, it's usually a longer-term dated treasury and a shorter-term dated piece of debt. And again, I've tabulated that below here so you can see both of those, and they're both currently negative. So why has the yield curve been such a good predictor of recessions? For that, we need a very quick crash course on how government bonds work. So firstly, the government will want to spend some money on something. It could be some new infrastructure like a bridge. It could just be simply to pay government worker salaries, just whatever the shortfall in money is. So if the government doesn't have that cash on hand, then it issues an IOU, known as a bond. This bond will have a face price, an interest rate, which is known as a coupon, and an expiry date, which is when the government will pay back the debt. So the government then offers that IOU up to the market, and investors such as pension funds or even individuals like you can buy that bond, exchanging their cash for the IOU. The government then gets the cash it can use to build its piece of infrastructure or pay the salaries or whatever it is that it needed that money for, and the investor can keep hold of that IOU knowing that the government owes them some money. Now, typically, the longer the debt issuance, the more risk there is for the investor. So, for example, if an investor is going to buy a 30-year bond, then the capital they use to buy that bond won't be repaid for 30 years. So they need to trust that whoever is issuing that bond, so a government or a company, is going to be there in 30 years to repay that bond. And so because of that extra risk, longer-term dated debt usually has a higher coupon, which is the interest rate, than shorter dated debt. Now, once these bonds have been purchased, the investor has a choice of what they can do with the bond. So firstly, they can hold it until it matures. So if you recall, the bonds are dated. So if the investor had bought a 10-year bond, then the government will pay back the whole amount, so the principal, in 10 years' time, meanwhile paying that interest rate at regular intervals in the meantime. So the investor might not want to hold that bond all the way until it matures, especially if it's a long-dated bond. So alternatively, they could offer it up in the market for sale, so they can trade it with other investors. So you can see here on a chart, this is UK government 1-year dated debt, and as you can see, the interest rate changes regularly. But why is that, even though the government has issued that bond, which theoretically has a face value and a fixed coupon? Or it's simply a function of market supply and demand. So if more investors want to purchase the debt, then they may be prepared to pay a premium for that debt, so that can push up the value of the debt. So in the same way, if you've got a company share, and more people want to buy shares in that company than want to sell, then people will have to offer higher amounts until people are willing to sell. So as an example, let's say the US government issues some 5-year dated debt, has a face value of $100 and a coupon of $5. So that means you could buy that debt for $100 and each year collect $5 or 5% interest rate, and after 5 years your initial $100 will be paid back. But if someone really wants to buy that debt from you, they might be willing to pay more than that $100. So for example, they could be willing to pay $110 for that debt. Now, because the coupon doesn't change from its $5, that means that the debt, which was paying 5% interest rate, is now only paying 4.5% interest rate because it's $5 on $110 instead of $5 on $100. And so that's how the interest rates can fluctuate minute by minute, hour by hour on government debt. So why, if longer dated debt carries more risk, is the yield higher for shorter dated debt right now? Now, there's loads of different factors that can impact treasury prices, but put yourself in the position of someone who wants to buy the treasury. Why might you want to do that? So typically, if you're looking to buy a treasury or a piece of government debt or a piece of company debt, you might be looking more for income rather than capital growth of your money. And that's because if you're looking for capital growth, you might be able to find higher returns in riskier assets, such as company shares, if you're willing to hold them for longer periods of time. But governments are seen as much more stable. It's very unlikely that a government is going to go bust, and therefore the debt that the government issues is considered safe. And so US treasuries are often referred to as the risk-free rate. Although I will say, as an interesting side note, companies also issue debt in the form of bonds in the same way governments can do. And actually, at the time of recording, Apple's 20-year bonds have a lower interest rate than the US government 20-year debt, which is actually indicating that the market is pricing in that Apple is safer than the US government at the moment for a 20-year time horizon. So if short-term debt is yielding more than longer-term debt, it could indicate that people don't want the short-term debt. So in other words, the market is predicting that the yield offered by governments on debt will start to come down in the near future. And so market participants are more interested in buying longer-dated debt because they can lock in a potentially higher yield if they're expecting the interest rate on short-term debts to come down. So if bond investors are expecting interest rates to come down, what does that signal for the economy? Well, most central banks have a mandate to look after certain areas of the economy, so it's typically something along the lines of keep inflation at 2% and try and keep full employment, so as many people as possible working, because those are generally seen as good things for the economy. Now, as I'm sure you're well aware, central banks have increased interest rates quite a lot recently to try and bring down inflation, and that higher interest rate causes a higher cost of borrowing, makes money more expensive in the economy, and therefore it means that companies might grow slower or might struggle more, which could lead to rising unemployment if the economy starts to struggle. So this means, in other words, that the market is now pricing that central banks will start to lower interest rates because the actions that they've taken currently will have a negative impact on the economy. So that's why we tend to see the yield curve uninvert and head back above zero. Because when the central banks start cutting interest rates, it's usually to try and stimulate the economy, or in other words, try and soften a recession or potential recession. So we can see here the Russell 1000 in red, and the Russell 1000 is often seen as a better measure for the US economy than the larger S&P 500, in the same way that the FTSE 250 is often seen as a better measure of UK markets than the FTSE 100, because it tends to have more companies that are just restricted geographically to those countries. And what we can see is that after the yield curve is uninverted, so after those blue circles, you can see there's red circles around areas where the Russell 1000 has then struggled, and you can see that's broadly lined up with previous past recessions. So where does that leave us? Well, as the first central banks, so namely Switzerland, Canada, ECB, have started cutting rates, and at the time of recording the US markets are predicting 2 cuts this year from the Federal Reserve, it means we're likely to see the yield curve continue to head back towards a return to normality, i.e. where short-term dated debt doesn't pay as much as longer-term dated debt. And if history repeats, that could signal a recession is on the way. But the markets have been through a very strange set of circumstances over the last few years. And this inversion, which is the longest recorded, so we'll see if it's just a reflection of that, or whether it is a precursor to another recession. Either way, it's likely to take a little while for the yield curve to invert, and then as we've seen previously, it then takes a period of time before you actually get the recession after it inverts as well. So if it follows historical patterns, it might be a couple of years before we start to see any problems in the economy. Alternatively, because of the supply shocks and unusual circumstances around the yield curve inverting in the first place, we may see that the Federal Reserve can thread the needle and that they can avoid a recession, but history is against them, and we'll just have to wait and see how that one plays out. So if you found this interesting, please hit the like button on this video to show your support. It really helps small channels like mine. And you can find more information like this in my newsletter, where I document my journey to building a £1 million investment portfolio. I'll leave the links in the description. In the meantime, the YouTube algorithm thinks you'll enjoy these videos.